Audio morning brief for the U.S. stock market, 8:34 a.m. Eastern Time, December 29th. I'm Rich Potts for Critical Point. Let's begin with the bond market first because I think bonds, interest rates can impact the stock market in the next 1.5 weeks, 2 weeks. We may learn it can make an impact for most of January because they may want to put interest rates higher into late January for the Federal Reserve meeting. So the model suggesting that the surge higher this week in bond prices, fast drop in interest rates, but it only lasted 1 day. That was kind of like flash in the pan and a last minute move to put in not only a level 3 top in bond prices, but quite possibly the more important level 2 top, meaning the second most important top or sell signal per year, for a year, during a year, for bond prices. This means an equivalent, the inverse, as a bottom for interest rates. I think interest rates can move above 4% for the 10-year Treasury note. Now, the model is showing that if the 10-year March 10-year Treasury note futures trade below 112.180, that we should use the critical point tool to generate downside objectives of 111.305 to 111.190. Now, that's not much of a move, and it may be all we get because we're going to see some stability in January. But that can be the start of stair-stepping, meaning multiple downside objectives over time for bond prices. The inverse would then be multiple upside objectives, targets for interest rates. The faster the move up in interest rates, the more likely the stock market will become sensitive. I realize on a long-term basis that the stock market does appear to be decoupling from interest rates and wants to focus on business, the actual stocks. However, it's going to still have short-term moments, it always has, of when it will refocus on what's going on in interest rates. I do think interest rates, free market interest rates, have come down too far, too fast, too soon relative to when the Federal Reserve will lower rates. And I think the market's going to wake up to that and at times show stability, sideways move. But in that sideways move, it's going to have to bounce some. Otherwise, you can't build a sideways move, a range, okay? So there is that potential to rebound interest rates some at times, okay? So now, if the market were in the next 1.5 weeks or something, trade above the high of this week of 113.120 for those March 10-year Treasury note futures, there'd be signs something's wrong with our forecast. We got to start over. But right at the moment, it looks like we're looking at something more important than just an frequent short-term bottom in interest rates and top in bonds. That something is occurring here. I think this increases the odds we can be right. The stock market is going to slip some for early January and may even slip or be complicated sideways throughout January until they get the Federal Reserve meeting. So next we have to take a look at what does this mean for the stock market? Well, it's possible the cash market yesterday placed that level 2 top that we called a week or so ago, and we were early on it, that it's placing it, okay, or has placed it. We look at the futures, we can see the futures may have actually placed it even overnight, and the futures are now backing off here, showing a little softness. The people following the Santa Claus rally history suggest today ought to be a down day within the Santa Claus rally, meaning they believe the market will be back up on Tuesday and or Wednesday of next week, and then the Santa Claus rally is over. Now, that doesn't mean they're going to flip to being bearish. They may have other studies, other seasonals, and other things they're looking at where they'll continue to be bullish throughout January. All they're saying is that specific Santa Claus rally indicator, if you will, is over and done with, okay? So we can still be early on this, but I'm thinking we're finding a level 3 top, and the NASDAQ yesterday was a little softer or not as strong as I would have thought relative to the S&P 500 and Dow Jones. And I think the NASDAQ's doing a better job of giving us a clue that it would like to roll over and like to go down, okay? I took a look at the percent stocks above the 200-day average for the NASDAQ and the S&P 500, and it's kind of stalled out. It's having some problems. Now, the problem with this is this slowing down as we rallied since December 20th, and you can even say we've been slowing down for much of December to date, and lower volume. What it means is there's less and less buyers, but there's even less sellers, so a smaller group of buyers move this market higher. People, especially using Wyckoff technical analysis, don't like that. They don't think that's the best of demand, and we ought to view it with suspicion. Other types of traders, even fundamental traders who look at volume, would probably say the same thing. You can't go up a steep hill and back off on the gas pedal. Sooner or later, the car is going to stall. It's going to roll backwards, okay? So you look at that saying, okay, this is a sign really shouldn't buy this market, okay, that you ought to be thinking there is time for setback. The problem with that thinking is it may have just been caused by the holidays, of people just shutting down a bit. And after the January 1, they decide they're going to buy all during January. I am looking at as an alternate scenario and one that can give us a little problems here as we anticipate a setback of the level 2 type, that it's time to set this market back some, stall it out a little before we move higher for 2024. So I'm still long-term bullish 2024. All I'm saying is there ought to be a little ripple at least now in the next few weeks, okay? And we're trying to time that, and I've been early on the S&P 500. I've got caught up a little bit of understanding it with use of the NASDAQ, but now even the NASDAQ is showing signs really ought to throw another dart at this thing, okay? That we're really not off the mark much at all. This can still work, but I also realize the market may go higher for early Jan, then pull back late Jan. But I'm guessing it's going to top now or right at the start of Jan, meaning next week, and then it's pull back. So I think we're getting closer to that pullback, but we need some evidence we might be on the right track. And some of that evidence would be able to trade below 4768.90 for the daily S&P 500. And we may only have enough downside potential here to take it down to 4,700. It may not be all that big a deal in relative to today's market and the volatility. Another way of looking at this is that the model's already showing there is potential to trade down to 47.25 to 47.70, but the model's warning it can add additional stair-stepping lower targets, just as it can do the same thing in bond prices, just as it can also do stair-stepping higher targets for interest rates. I think the two are going to couple together here a little bit, and we're going to see a ripple in bond prices, interest rates, and a ripple in the stock market. And at least for our stock market forecast, there's still a chance for this setback in the stock market. And I do think there's a potential to at least take it to 4,700. What we have to be concerned about is something could go wrong during January. It might be as much as 4% down from whatever the high is going to be now in the next week or so, okay? So there could be that much downside, but that seems to be the worst case scenario, and I don't think we're headed for the worst case scenario. We're just going to have a little bit of a ripple for this level 2, and then the market's going to be higher by February, may even be at a record high for the S&P 500, whereas NASDAQ and Dow Jones have already seen record highs, so by February they can put in additional record highs. So hopefully this makes some sense of how this is unfolding into next year, into February, as well as what's going to happen in the next couple of weeks here. And now we just need some kind of evidence. We need somebody to sell something. The sellers have been burnt so much that they just decided, let's try to wait to get the year done. And then the way they look at it, they have an entire year that if they make mistakes selling, they can get something back and readjust. Meaning they can become more brave starting January 2nd of trying to sell the U.S. stock market. Now, if the S&P 500 trades above the current high of this week at 4793.30, we have to consider they want another stab or run at the current record high of 4818 for the S&P 500. Okay, have a great weekend, a great New Year's holiday, and I wish everybody the best for 2024, and I think we're going to have a prosperous, profitable year in the stock market, and I feel like I'm really up to the challenge to squeeze out what we can out of it. I think the model's working quite well, and I think we're getting back to some normal bull market type trends as we get the economy back to normal. But the point is it's net growth economy and a net bullish stock market for the U.S. and hopefully the world's going to calm down a little bit and enjoy a little bull market globally. Past results and unassigned ticket future results. Have a great day. Thank you.